Welcome to Upside, where we dig into the real stories that live behind the headlines affecting European venture. On the docket this week, we've got Figma's IPO and London's lack of, how Euro stocks are storming ahead, UK government budget hole, why that matters to us, the EU AI Act, why that may not happen just yet. Will the internet die thanks to AI? Ooh, big fat debates there. The doctors versus AI. I don't know if you've heard about this, but who won that benchmark test? And the latest from EU Inc. and their plans to boost Europe's startup ecosystem.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So let's start right at the top, gentlemen. But before we do, how are you? Lomax, what's happening with you? Are you all good, all bad, all up, all down?
I'm great, man. I survived the heat dome that we had in Portugal, over 40 degrees, which was pretty intense, I have to say.
Yeah.
Every year we seem to get one
fun.
of these heat domes. But we get one for like 2 or 3 days every year now. It seems to be pretty consistent, but this was earlier than normal. And I don't have air conditioning, so it's been pretty insane. Luckily, we are on the Atlantic, so, you get the breeze if you head out there. And we opened our office this week. I've been updating you about this, and we had 30 AI founders in the office for an event on Thursday evening.
And this is Lisbon, right? I mean, just to share where you are
Lisbon.
And what it is.
This is actually just outside Lisbon on the beach, 20 minutes outside the city centre. So showers went in this week as well. So, come for a surf, followed by, early in the morning, followed by some coding. That's been really cool.
Nice. Matt, what's been happening with you, dude?
Hey, it's a great time of year. It's kind of, end of the school year. It's kind of holiday season is looming right around the corner. And, all the girls are on the last kind of mile of their journeys
They
here.
must be all genned up for holidays. That must be so exciting.
They're so ready for that, for sure. It's a bit of a slog towards the end, but it's good. It's great.
And I'll tell you what's not on the docket is do VCs disappear for summer? But I did write about that recently, and there is some research to be had if you're thinking of pitching investors over the summer months. I say still go ahead, but there are some quite stark figures as to who's
fundraising
in and who's not.
does follow. Fundraising does follow term times in a way. Timetables.
Yeah.
You're still following the school timetable.
Interesting.
Yeah.
Right, let's start right at the top. So Figma, they are filing to IPO in New York at long last. When is a bit of a TBC, price TBC, but it's all happening. They filed after the failed Adobe acquisition effort 18 months ago or so, which earned them a cool $1 billion in dropout fees, which is nothing to be sniffed out. Here are some interesting Figma facts before we kick off. So Figma is 13 years old. It was founded by college dropout Dylan Field and friend Evan Wallace. Dylan is 33, so he kicked this off at 20. Quite amazing. Took 7 years to get to 1 million users, a further 5 to get to 12 million users. And I think the last time I saw, about 95% of Fortune 500 companies are using it. So it is all over the place. But Mads, why is this important? Why are we talking about this on a European-focused podcast? It's cool, but kind of so what?
So firstly, this is an incredibly important story. This is the story the venture industry has been waiting on for the past 2 years of sluggish IPOs and exits. And, as we've seen and we've talked about, kind of IPO markets have had a decent first half of 2025, but especially June has been excellent in the sense that CoreWeave and Circle, they really took off, delivering 3x and 5x returns to investors in a matter of weeks. Right, so that's been incredible for markets. Everybody's very, very buoyant right now. And CoreWeave and Circle are cool companies, but they are not SaaS companies. They're infrastructure companies. So vertical AI, which in many ways is the next gen SaaS. And, for us, for those of us who invest in this space, well, for that segment, Figma really is the bellwether. And so if Figma prices well, that opens the floodgates for Databricks, for Stripe, potentially for a bunch of other companies that we've been looking at. And Figma is a terrific company. And so I don't know where you want to take this, but we can talk about some of the stats behind the business. We can talk about links to AI. We can talk about links to Europe. What do you fancy?
Well, I want to talk about I'm going to come back to you in a sec. I want to talk about the business a bit first, because I was reading some of the figures, Lomax, and they made a paper loss of $730 million in 23. So for those that don't know the thinking, the reasoning, just on the business side for a second, what happened there? And because obviously that, to the layperson, that looks like a little bit nuts. And now they're going for this, huge IPO. So give us a little bit of the context and story of how that all happened.
Yeah, I think in some of the coverage, there's been a quite a lot made about this loss. So for context, in 2023, the company made a 138 million profit, and then in 2024, it made a 732 million loss. Now, that was all driven by a one-time event of a big issue relating to stock-based compensation. So
it's not cash, right?
This was a paper loss. It's not cash, right? So if you look at this is why you've always got to look at the cash flow statement versus the income statement. You've got to look at both at the same time, right? For the full context. So the backstory here is the company, as we know, was going to be acquired by Adobe. That deal was vetoed by the FTC in December 2023. The employees were planning to make, in their minds, a lot of money at the 20 billion exit. That didn't happen. So in May 2024, to restore and reboost morale, the Dylan Field and the C-suite organized a tender offer, basically to enable employees to sell their shares and their options. What that meant technically was that some of them were still tied up in investing. So vesting, normally when you give shares or options to an employee, it vests over time, but also there's an additional condition often that vesting will only occur on an exit or an IPO. Now, they waived the exit IPO condition. Now, what happens is, this is a very technical kind of accounting standard under GAAP, US GAAP, is that stock-based compensation flows through, like a bit like when you pay an employee cash, but if you give them stock, it flows through the P&L. So it's a cost item, right? Right. And so the way it works with options and shares is, as shares and options vest over time, as they get released to the employee, the value accrues to them. That is recorded in your income statement as a cost. And in this time, it was a huge one-time cost of 800 million. This is not uncommon. This has happened with Stripe, with Palantir, with Uber. It kind of happens when there's a big reset or, resetting of the options to enable, for example, a big sale, which is exactly what happened with Stripe a few years ago, as you might remember. This happens. Lots get made of it. It's a paper event. So it shouldn't, not much to look into really. Quite frankly, the headlines the headlines tend to be hyperbolic. Interestingly though, the silver lining though, of course, is it reduces your net income. So it actually reduces your tax bill, of course. Yeah. So, it's not all doom and gloom. Actually, from a cash perspective, it's potentially good. So that's what's going on there.
Great. Thanks for unpacking that. Mads, give us some more insight into the S1 and the filings and the actual detail of the deal.
So as I mentioned earlier, Figma is a great company. More than $800 million of revenue over the past 12 months to March 31st this year, growing at 46% year on year. So that's 10% a quarter. And for context, Adobe, that was trying to buy the business, they're growing 10% a year. So kind of a real growth engine they've built here. If they've kept up that growth rate here in Q2, we don't have the numbers yet, but they should have crossed the $1 billion ARR threshold in Q2. Wow. So that's just a terrific performance when you grow at that level. And 91% gross margin, as you mentioned, used by most of the Fortune 500 companies, used by 78% of Forbes 2000 companies. So really a solid land and expand business, 132% net dollar retention, best in class. And I think we'd all like a few Figmas in our stables.
So this isn't a fluff deal. This is fundamentals. They're going to carry on growing. There's lots more scope to go, you think?
Figma is an awesome business. And what Figma and what the Figma deal will test is the market's appetite for software deals. And if they price well, it will bode really well for the market.
Yeah, great. Who was in the deal? Do you know?
So once again, and there's a strong European angle here.
Yeah,
because
boom,
Index Ventures is the largest shareholder, and they're standing to rebate potentially $5 billion return. They were also the lead investor in Wiz. They were the lead investor in Service Titan. They sold Dream Games to CVC and Blackstone in the past year. So the index has been absolutely killing it. And I think you could argue that it is quite possibly the best performing major VC firm in the world right now, based right here in London.
Nice. We'll take it. I want to talk about
an
London.
absolute beast.
Thank you for the segue. London not faring not so great, shall we say. Here's the other side of the IPO story. So this year, and I don't even want to share this story, but we're going to do it anyway. This year, London marked the slowest H1, the slowest first 6 months for IPOs in nearly 30 years. Now, counter to the US's $9 billion for over 12 deals in the first 6 months, London has raised 160 million. That's 160 million for 5 companies. And now
Must be missing a B there somewhere.
Oh, I don't even. I told you I didn't want to share this story. But anyway, and AstraZeneca is also looking to relocate its listing to New York for all the obvious reasons I'm sure we don't need to go into. But so my question for you, Maz, if you can kick this one off, is can London come back from this? Are there any historic precedents, anything we can lean on? Because obviously everything ebbs and flows over time. There's good, there's bad, there's ugly. But can London come back?
And this is really a terrible story. I mean, we've just talked about some really great news. This is really bad. So, you're saying the slowest in 30 years. And we sometimes say, oh, it's the worst in 2 decades or whatever. And you sort of, maybe without thinking too much about it, the last 6 months were worse than the dot-com crash. Worse than the 2008 great financial crisis. Okay, this is the worst since 1997. Since before, I'm sure many of our listeners maybe were born. I mean, this is just unbelievable. And so can London come back? The trajectory is really not positive. In the 60s, London was the global number 2 after the New York Stock Exchange. And even going back 25 years, London was still competing with NASDAQ. But as we sit today, London is well behind the US exchanges and is neck and neck with Amsterdam and Frankfurt and exchanges that you wouldn't have put London in the same league as historically. And so, what can be done? The exchange has tried to make listings rules changes to sort of say, look, it should be easier to have dual class shares and, we can tweak the free float requirements. And that's a little bit like fighting the last war. So the US have had dual class shares for 40 years and a 10% free float requirement. I mean, Singapore already has 5%. So we're really copying rather than innovating here. And then there's this idea of Pisces, which is probably at best a distraction if we want to regain momentum. And so the question is, why is all of this happening? Is this something that's, could you just put that at the door of the London Stock Exchange themselves, or is there a wider implication? And this is really 25 years of structural decline. When I say 25, you probably have to add another 5 on that and take it to 30, because it started with the Pensions Act in 1995, following on from the embezzlement debacle of Robert Maxwell, who had embezzled £450 million from the pension funds of the Mirror Group. And so this new act made pension trustees directly liable for mismanagement of pension assets. And what does that mean? How do you mismanage pension assets? Surely the pension trustees are not regularly embezzling the funds, and of course they're not. But what the tone of the law meant is that the interpretation is that it's more important for trustees not to have year-to-year losses than to maximize long-term returns. Now, anybody who's in finance know that, if you want great long-term returns, you invest in equities. That's where the best returns are. But if you as a trustee feel that you are not doing your job, or you're told by the regulators you're not doing your job, if there's a year-to-year drawdown, well, we know that if you're in stocks, equities, they fall sometimes, right? And then they'll recover strongly in other years. So what's happened is that, for 30 years, trustees have been favoring bonds to smooth out those year-to-year returns as opposed to putting money into equities. And so that means that in 1997, UK pension assets, they were at 53%, but today they're at 5%.
UK, right?
And in contrast, UK, yeah. And so in contrast, bonds were 15% in 97, and today they're up to 45%. And so this is really a kind of a huge structural issue. And the question is whether London can come back, and we can talk about what some of the things you would have to do for us to get there. But there's certainly not a great picture we're seeing right now.
Well,
But- and
hold
I
that
think-
thought.
I think
Hold that
you-
thought. Let's come back to that. Lomax, before you kick off, can you just give us some context, kind of compare US, UK, just to kind of set the playing field for us?
Yeah, the numbers are staggering, right? So at the moment, if you look at, say, the market cap of like US listed securities, today that is 60 trillion, and in the UK it's 3 trillion, right? So it's 20 times bigger in the US than the UK. If you look at liquidity, daily liquidity, so shares bought and sold on the market, it's 4 billion in the UK, it's roughly 90 in the UK. So again, in the US, so again, 20 times. Apple, Nvidia, individually are bigger than all of the market cap of the FTSE 100. The daily liquidity in Apple is 4 times that of the whole of the FTSE 100. Okay, so the difference is staggering. Go back 30 years, there was clearly a big difference. Like, don't forget that the US economy is roughly 10 times the size of the UK one. So you would clearly always expect a large difference. Interestingly, in 1995, if you run the numbers that I just went through, the difference was about 10 times. So actually, it was kind of commensurate with the difference in the economy size. Now the difference is 20 times across those metrics. So it's a shocking. It's sort of shocking how the UK has been left in the wake of the US. Just picking up on what Mads was saying, the Mads articulates well on the demand side what's happened, right? The people who buy the shares, but on the supply side, there's a few issues. But let's not forget technology, which is our world, has played a big part in this, right? So technology is roughly 30 to 35% of the market cap in the US, right? Listed companies. It's 1% of the FTSE 100, 1%. So the apps, you've seen the growth in market cap in the technology companies in the last, since, through the internet, through cloud, through now AI. The UK listed markets have just missed that wave.
Mads, how much of this is Labour, and can London come back?
Well, I think as we've just talked about, it goes back to 1995, which was a Tory government, but certainly all the decline has taken place under successive Labour and Tory governments. Brexit accelerated to some extent, but the culprit really goes 30 years back. And so, to answer the question, what needs to be done to address it? Can London come back? And I say, in theory, yes, but you would have to change the pension rules. I think the 3 things that can be done is you need to shift the fund testing horizon so that you reduce the penalty for riding out market dips. I mean, it can't be that pension trustees don't want to invest in UK equities or equities in general because they're too afraid that there will be a market drawdown when we know that returns are better over time. I mean, let's not forget, this is not just hurting the availability of capital for productive UK enterprise. It's also hurting the returns of pensioners, of future pensioners. And the second thing is around this, right? I mean, it's a terrible situation.
I was going to say, do we not, if you're a pension trustee, are you not sitting there being like, oh God, like we've seen in the last few months, the Mansion House Accords, where the government and the venture capital industry and the privates industry is trying to get pension funds to allocate more into privates, right? And we're now sitting here talking about how do we fix the stock market? We fix it by allocating, more away from bonds into public markets. So these poor pension trustees are sitting there being like, oh Jesus! Every time there's a problem in capital markets,
my fault.
We're the solution, which is it's not. I mean, it's not unsurprising. I mean, that's 3 trillion of AUM that they have, and so if you're a government, looking for like private money, it's like how do we like shore up or bolster these industries? Like clearly, who do you ring up? The insurance companies and the pension trustees. It's just the poor people must have their tin hats on at the moment.
Yeah.
Yeah, and maybe that's justified. You could say it's not their faults that the rules have been made the ways they are. But even so, I mean, there are very real structural issues. Today, let's just share a few other stats with you.
Yes.
Pension savers today get very generous tax breaks. Okay, it's costing the Treasury £40 billion a year.
Wow.
Right?
Yeah.
To put that in context, UK pension funds hold about £150 billion of UK listed equities. It's less than 4 years of tax breaks.
Yeah.
Right? I don't think it's unfair that we say if you get these incredible tax breaks for putting money into your pension, that some of that benefit should accrue to UK PLC in the form of productive capital being provided to companies. If not, where's the money going to come from?
I agree. I agree. What's interesting also, by the way, is that pensions play a big role in a lot of what goes on behind the scenes, because what we just said, I mean, it's a lot of money, right? If you look at what one of the big unlocks for US venture capital back in the 70s was the law changing and enabling US pension funds to invest in VC. They had this prudent man rule in the ERISA, the relevant US employee retirement income savings act, is they made it more permissive for pension funds to invest in venture, and that unlocked tens of billions into the asset class and almost created what it is today. So it's very interesting that a lot of this comes back to pensions and how you regulate them. And Europe's gone one direction, the US has gone another. One's gone more permissive, one's gone more restrictive. And look at the long-term consequences.
I think
Before
that's
we move on
exactly
to-
right. And sorry, Dan, just before you move on,
Yeah,
I
yeah,
think that's
okay.
exactly one of the key issues we have is this definition of what prudence means. In the US, prudence means balancing long-term expected returns with short-term volatility, because that balance is important. But in the UK, prudence means don't suffer any short-term losses. And you just cannot maximize your long-term returns that way. So it seems clear to me that we need to look at the regulation here if we want to unlock this market.
Yeah.
Before we move on to,
yes.
Sorry, no, you close off, and then before we move on to the European side of this, I want to just come back to the Mansion House piece.
I don't
that
want
Lomax-
No, I'm just trying to tie it back to like what we do and everything. It's like, well, clearly the financial services industry in London, the people sitting in the Gherkin and formerly Canary Wharf and those kind of areas, they're clearly suffering. I mean, we're talking about 160 million raised in IPOs this year. I mean, they're taking 5% in fees. So the fees they're taking are minuscule compared to what they would have taken in the past, and also what their peers are taking in the US. So that industry is clearly suffering a lot, which will affect the country because they would have been big taxpayers historically. But actually, if you're in tech and you're building a big company, you just take your wares to a different market. You got a cow, you ship it, you take it to a different market. Like, it's very simple. So that is, like, in a way, if you're still a company builder, the message is keep building and you just go and IPO in the US. I mean, it would be a shame that our European pensioners, UK pensioners won't have as much access to it. But I mean, if the rules are what the rules are, that's a policy problem, and you don't need to worry about that. You just keep building, and you'll find a market for your securities.
Mads, can you just dig into a little bit more on the Mansion House piece? Will it work? Is it enough? Because I know that everyone knows what's going on in government, and I'm sure they're having very similar conversations. But we know that obviously the Mansion House is out there. What's happening with that, if anything?
Yeah, so that's the question people are asking isn't all of this solved with the Mansion House reforms? And the truth is, I think they are very well intentioned. We need more capital to be put into private investments in the UK, not just venture capital, but just assets in general, energy generation, infrastructure, etc. So I think all of that is good. But the truth is, there's a dearth of capital targeting UK listed equities. And if we want the UK and London in particular to be the thing it was, and I think could be, which is a center for listing not just UK companies, but companies from across Europe and elsewhere in the world, that means we need to have capital. And if the capital isn't there, the IPOs can't take place. And then you have the negative cycle Lomax talks about, which is impacting our public finances because there's not enough people making enough money to pay the taxes we need to fund the country. So I strongly think that public markets should be the ultimate buyer of private assets. Eventually, companies should go public. It's much more democratic. It's much better if everybody, including pension savers, can share a stake in the best performing companies. And so I think in terms of this strong focus on the mansion house reform, it's a little bit like putting cart before horse. I think we need to fix publics, if anything, before we fix privates, because they are the ultimate buyer. If they're not there, the rest of the waterfall is not going to happen.
I think that's right. And also, I think this is good for society, to be honest, generally as well, is like, actually, you want the big companies that control big parts of the economy but when you're a public company, you're held to account. You're held to account. You know, SpaceX is a 350 billion, whatever the latest valuations. They have like no accountability at all to anyone. I mean, in some respects, do you know what I mean? So, you know, I think Zuckerberg has even said this, like he actually quite likes being, and maybe he's just saying this, but he says he quite likes being listed because it makes him run harder. You know, he's accountable in a way that you're not when you're private. And I think it's better for everyone when you are. And I know we talk about the problems of quarterly reporting and the short-termism that can lead to, but ultimately I think, you know, all roads need to lead to the public markets. I really think they do.
And we are, I know this is a minor point, but we can't forget the recycling aspect of this capital and how this fuels our industry. When our investors do well in publics, they will do better in privates. It just keeps the whole, and obviously we have all the founders that are then recycling and becoming investors. So there is a very, very strong recycling aspect to all of this public and private activity. But Europe isn't faring quite as badly. So now time for something a little bit more upbeat. So European stocks have outperformed their US peers by the biggest margin on record, with the euro up 13% against the dollar in the last 6 months. European inflows are much more meaningful. European-focused equity funds attracted 46 billion since the start of 25, on track for the second largest inflow ever, compared to 66 billion outflows same period last year. So Mads, the fundamentals haven't really changed that quickly in Europe. It's still very fragmented, regulation heavy, sluggish growth, all this stuff. But this is big news, and it's happening for reasons. But is it sustainable? Is this going to be a longer term piece, or is this just the anti-Trump, anti-US piece? What's happening here?
I think that's a great question, because on the face of it, this looks like classical rotation. You know, every few years when the U.S., tech and the U.S., economy generally gets a bit frothy and the world gets a bit too turbulent, you're seeing some rotation out of the U.S. and into other markets. Last time it was in 2017, 2018, lasting for about 9 months. And you'd say, on the face of it, maybe not sustainable, maybe nothing to see here. But under the covers, something real is happening beneath this rotation. And I think the real story here is that Germany has finally woken up after 20 years of slumber. Now, Merkel, her legacy was, no infrastructure investment, no defense investment, no digitalization. You had an energy crisis that was forced, from all that over-reliance on Russian gas. And what we've seen now over the last few years is really that strategy has been facing a profound reality check. The German economy completely stagnated for 5 years. And finally, you have a German government that is saying, look, let's invest. Let's take a much more proactive stance in trying to drive the economy. And that's great, because the German industrial base is absolutely world-class when it's given the right direction. It's 25% of the EU economy. And when Germany invests, suppliers across Europe benefits. Defense spending is flowing to Saab in Sweden and to Thales in France and Leonardo in Italy. Infrastructure spending is pulling in the Spanish construction industry and Dutch engineering talent. So there's this multiplier effect that can happen across the continent. And so I think, to your question, what's going to happen from here? Well, I think the beauty of it is it's down to us. If we seize the opportunity to combine this, slightly buoyant or possibly buoyant market opportunity with some real reform around capital markets, around energy markets, around regulation for startups, which I think we're going to talk about today, this could become the start of something really good.
I want to broaden it out slightly, because something came to mind as you were speaking. It kind of feels like putting the UK back in the bucket here, even though we're not officially part of Europe. It feels like it's AI tech is all US, and then everything else is over here in Europe. So Lomax, is that true?
I think that's an oversimplification. I mean, clearly the non-AI economy in the US is very, very big and in parts performing well. So I think it's more like there is a dearth of, if you're looking at listed securities, like listed AI companies that give you AI exposure in Europe rather than anything else. So I really don't think that's the case.
And what with obviously governments have obviously woken up, the EU has woken up. How much of this is going to be government controlled? It feels like there's multiple conflating forces in a positive sense. So we've got this rotation.
I think the rotation is actually a bit ephemeral. I think it's as Mad says, it can be cyclical. I mean, you can point towards this Germany fiscal loosening, so the 500 billion of investment as being a really, really positive thing, but it's obviously government driven. You know, one thing that you've got in Europe that you haven't got in the US and the UK is rates are much lower in Europe. You know, rates are 2% versus over 4% in the UK and the US. Why is that? Well, you know, there's less inflation, there's less growth. So some of it is, I think, benefit of sort of central bank decision making, government decision making, and I'm always a bit suspicious of that. Like, is it actually a secular shift, or is it sort of fiddling by the people in Brussels or in Berlin? You know, because you're not really seeing. I don't think you'll see. You know, you'll see it's very sentiment driven. I don't see the growth in the earnings that being particularly spectacular. I mean, Germany, the economy has sort of returned to growth at a slightly faster pace now. Like, we'll see. I think this spending will take time to trickle through. I think there's plenty of room for optimism, and I'm not just not as optimistic as Mads about this. You know, part of this is just like the Trump chaos has just caused people to rotate out of the US and look at Europe has always been cheaper than the US. You know, US is roughly on average 20 times multiple, you know, price to earnings, whereas Europe is more like 12 to 13. So there's a sort of arbitrage, you know, or not arbitrage, but there's certainly a price differential. But then, you know, if the companies are growing more slowly in Europe, then really is that a sort of false, is that a false profit, as it were, or a false benchmark for success?
But there are levers to pull, Mads, aren't there? There are reforms, there are actions that governments can take, that business can do. What should we do?
Yeah, I think I have a natural bias for optimism, but I think sometimes the trick is also to squint a bit and imagine what could be. I do firmly believe that we have our destiny in our own hands. I think we're just as well educated. We got super modern, sophisticated societies, and I think in some ways we have benefits that the Americans don't, in the form of proper better social cohesion. You look at some of the Nordic countries that have relatively high tax burdens, but have managed to grow very fast and develop very high GDP per capita bases with economies that are just a little bit different from what you're seeing in the US. I also can't help but think that a society that is maybe more stable, has slightly less turbulent swings than what we've seen in the US, is going to benefit business. So while I agree the US is still the world's leading economy and the best place to make money today, I do think we have everything to play for. And if we grasp the nettle and make some of the necessary reforms, I'm hugely bullish Europe. I think it's all down to us.
I'm with you. I think you have to take these opportunities. I'm not with you, Loma. I think you get these little kind of, whatever they might be, environmental, fiscal, government regulation, Trump-esque. And then if you get the lever, you get the opportunity, you go, okay, how do we get to the next lever, to the next lever, to the next lever? So I think between this defense resilience, this renewed kind of wake up across Europe, I'm more than optimistic. But I am going to take us on another emotional journey.
Should we agree to disagree? Okay, let's agree to disagree. When do we talk about the AI Act?
Oh, don't. Well, we will. We're going to come on to that, and we got some more on that later. But before that, we are going to go a bit more Debbie Downer. I'm going to take you on this super emotional roller coaster this week because we do need to talk about UK reform on benefits and this new €5 billion pound hole. It's a pound hole, isn't it? So the UK fiscal policy, the reform failed. The 10 billion of budget headroom is now shot. Interestingly, I found that other chancellors usually gave themselves 3 or 4 times that, the 30 to 40 billion fiscal headroom
that's
space.
a big difference. Yeah.
So there wasn't much to play with. Starmer's U-turn has created this £5 million hole due to welfare cuts that now won't happen. If we miss our growth targets, and we are looking at roughly 1% plus, and if you look at either the independents or is it the OBR and what the government are saying, they're all slightly all over the show. And as you go over time, then the differences between what the independents think and what the government thinks start to go in opposite directions for the wrong reasons. But if we miss those growth targets by even slim margins, this is going to be pretty catastrophic for the UK economy. And just for some context, the UK tax receipts are just over 1.1 trillion, and our spend is just under 1.3 trillion pounds. So there's roughly 160 billion pound deficit currently, but it's growing. So Lomax, kick this one off. So we've got taxes up, more cuts, more borrowing. What's going to happen, or is it all of the above?
Well, it's difficult. So she's obviously set this rule, her fiscal rules, and if you as a chancellor break your fiscal rules, then you're kind of finished. I think you send a very, very, very negative signal to the bond markets. I don't know where she goes from here, because as you said, most chancellors historically have had a 30-40 billion margin for error. So if things go against them, they have this sort of headroom. So she's set this rule to balance the books. Therefore, to have all spending covered by tax receipts by 2029, and we've seen the various things she's done to try and get to that position. It's a mixture of taxing more. We saw that with the national insurance increase. It's
just one quick point there, Lomax. We are now, I think I'm right in saying, both of you correct me if I'm wrong, we are now at the highest tax burden since World War II.
Yeah, across the piece, yeah. So she's also pledged, right, in their manifesto, that they're not going to increase taxes, right? So she's now in a sort of, what do you do? Well, if you can't increase tax, what are the levers that you pull? You can either cut costs, you can increase taxes, or you can increase borrowing. If for example,
or
the social
growth.
Care budget, but it's not a lever you can actually pull. Yeah, it's an outcome of the decisions that you make.
Yeah.
Okay. So the actual levers that she can directly pull. She's constrained on cuts. We've seen this. I mean, the social care budget is pretty much the biggest budget that the UK has. I think we're spending, I think the NHS plus social care is about 400 billion. It's nearly half of the government spending,
it's roughly
right?
half. If you add up all, because they break it down into certain buckets that you then need to re-add up to look at the full social care budget, and I think it's roughly half.
It's sort of this secular decline that these economies face as part of an aging population. But anyway, let me just go back to what I was saying. So I think she's in a bit of a rock and a hard place, because she said she can't raise taxes. She's constrained on cuts. And so therefore, what does she do? She has to go and raise more money, which I think the bond markets won't like, which increase borrowing costs, especially in a higher interest rate environment. Look, I think I'm trying to work out what this means for us. One of the biggest things that stood out to me was, these guys, Labour's now been in charge for a year, and it's been a bit shocking, to be honest. There was so much optimism. Don't forget, they had one of the biggest majorities that any government's had in the last 25 years. They had a majority of 165 seats. So you would have thought that it would be easy to get these kind of things through. What do you want? You want a strong government that can set out an agenda and push that through, and then deliver results off the back of that. And maybe one of my reflections is what's happening to, you're reminded that the Labour Party is as fragmented as the Tory Party was, and what happened to the Tory Party? It got eviscerated by infighting and from those on the left and the right elements within the party. And now the same thing's happening to Labour. The centrists who want to push through these reforms, push for growth, push for infrastructure, and also, reduce the tax burden if possible by reducing cuts, they are being constrained now by the left of the party. And I do worry, if you're looking at the UK kind of broadly, and we've seen the markets have reacted very negatively to this, although it's softened a little bit since in the few days since, is that generally for UK PLC, or just the UK and our perception in the world, this is a challenge. And I think it shows that the sort of, if the Labour government with a majority of that working majority of 165 seats can't push through reforms like this, then how's this gonna sit over the next few years as they push through other other reforms, right? So especially
But
with zero
Corbyn
headroom,
has
they've got
just
no margin
spun
for
out,
error.
hasn't he? So Corbyn, and I've forgotten the
Yeah.
lady's name he's going with. They've
Well, he was
just spun
expelled.
out to set
He was
up-
already expelled from the Labour Party. Don't forget that. But yeah,
Oh, I forgot that. So, but he's now setting up his own party, and I'm wondering if that draw for the hyper lefties will then go and join Corbyn. And so my head went to, will this mean that there will be more availability for a centrist push because the super lefties are going to go and join him? And it was a sideways thought.
yeah. Yeah, I don't think this is great for business. Basically, if you go back to business and startups and tech in the UK, I'm not sure it's brilliant. And you could well end up with Angela Rayner. There's a lot to admire. Her backstory is fascinating, but
Yeah.
she could end up in number 10. I don't think she's pro business. I think it's the opposite.
Yeah.
So that's a problem.
Mads,
Do you know who's going to end up in number 10, Lomax?
Angela Rayner.
Nigel Farage.
Well, one of those two.
don't.
So
Yeah.
it's not great for it. Yeah.
Yeah. Rock in a hard place, right?
If you just talk about this Labour Party fragmentation, Labour kind of spinning around, not getting any traction, it opens the door. Conservatives still in a complete mess. It leaves the door open for Farage, as you say.
I remember
We're hammered by the first past the post system. It's an absolute diabolical mess.
I remember when Keir Starmer was first elected, I remember thinking to myself, and I was saying to my wife, I just love the fact that we've got somebody boring. I love the fact that he's just ex-lawyer, boring, methodical, thoughtful, smart. And now I'm kind of having to eat my own words because he's just not strong enough. There's just a lack of grit or a lack of, I don't particularly want Trump levels of crazy FU, I'm going to do it my own way. But I think there's maybe a middle ground that I would prefer to see. But Mads,
Contrast the two administrations this week. So the UK reforms, the welfare reforms, utterly failed. We're completely gutted by rebellion and infighting. And Starmer is basically left with a total mess to try and resolve. And with 4 years left in office, I mean, it's just not a great situation. At this point, we should just have an election because this is ungovernable. Now, the alternative is, look at Trump. He had I don't think, not very smart bill, kind of this, build back, big beautiful bill.
Big,
He wanted
beautiful
to,
bill, baby. The
yeah,
BBB.
exactly, and was able to push it through. And so, to your point, I completely agree with you. We don't need the theatrics he's presenting, and there's so much to dislike about his policy platform. But I think in policy and in politics, if you can't push your agenda through, you're a lame duck, and that's pretty useless.
Yeah.
Yeah,
Starmer always used to say, "Look, I'm not a politician. I'm not an insider. I used to be a lawyer, whatever." And he uses that as an excuse. And it's like, no, I'm sorry, man. Like you've got to at least do the politicking well. Like get your whips to make sure that. Yeah.
So he won't make it. Do you think Reeves will make it?
I think one option for Starmer is to because how do they get out of the bind that we talked about at the beginning, which is they've already promised not to increase taxes, they don't want to increase borrowing, they're now constrained on cuts, they've now kind of backed themselves into a corner. I think the only way that you could possibly get yourself out of that corner is to fire Reeves and be like, she's out, we're going to do a new fiscal rule. I don't think that's going to end well.
And then fight the
I
party.
think I don't think that's going to end well. You what are you going to do? I mean, you're going to placate the rebels by potentially appointing a slightly more left-leaning chancellor or whatever. That's the markets are going to hate that. So,
Mads, we've got three scenarios. We either stay. This stasis has been around for a long time. This kind of gradual miserable decline. We've got further decline, or we've got righting the ship and actually turning the ship around. Could you have a bash at breaking down those three boxes for us?
I mean, let's start with the kind of central scenario, the model through, because we're very good at that. And this is what I think will happen, by the way. I think they will patch the fiscal holes with stealth taxes. So that means increasing the tax thresholds. That means that you push 6 million people more into higher rate tax. You're probably going to revalue the council taxes because so many of the councils have such poor fiscal positions. And that means that being wealthy in the UK will be redefined down to somebody making £60,000 a year. And of course,
hold
that's
on, Mads.
not nothing.
I'm pretty sure I'm right in saying that 75% of tax receipts are paid by people earning over £50,000. So if you like, the wealthier members of society are already taking the majority of the tax receipts pie already. I don't know if anyone knows anything different to that, but that was the last figures I saw.
No, that is correct. And you're going to redefine what it means to be wealthy. So people that are now slightly poorer will also be contributing
in the pot
more,
in
right?
That
So
pot,
it's
right.
you push up the tax burden basically. You're going to have zero reform momentum because welfare is basically untouchable after this PIP rebellion. You are going to have an NHS which continues to be sacrosanct, which means no productivity push. We've talked about how you've had a lot more money put into the NHS over the last 5-6 years, but with declining productivity, you're not going to fix some of the important things around stock options that need to be reformed. You're not going to see some of the pension reform we've talked about. And effectively, you're at risk of the UK gradually becoming more of an R&D lab for US companies. Now, the irony here is, as VC investors, we're probably going to do okay in this scenario. We're going to keep building and funding early stage companies, and eventually they'll flip to the US. But there is another scenario where UK PLC makes more from those investments. And of course, that's the one we would really hope to drive.
And so anything on the other scenarios, I don't really want to go into the doom and gloom and the death and destruction, but is there anything that we need for context just to share?
Yeah, I mean, riding the ship, what would you need to do? I mean, you'd need some bold reform. We've talked about pensions. They're super important, but you also need to reform the welfare state. And one thing you could start with is, means testing state pension for wealthy pensioners. I mean, we just cannot afford to pay everybody so much money. It's
But
just
they
not
tried
enough.
that
We've
with
got to have.
didn't they try that with the heat? What was the winter fuel allowance?
Fuel allowance, yeah, which you turned on.
Yeah, so it feels like that kind of process.
It's very, very hard. It's very hard, especially if you're a Labour government.
Even Theresa May, she stumbled in that, right? That was one of the things that ultimately pushed her from office. But that wasn't the question. The question was what could or should be done. Now, we've already given the what do I think will happen scenario, which I don't think is great. It'll be more muddling. But what I think should happen is exactly this. It's reform. It's a productivity push in the public sector. It's AI diagnostics in the NHS. It's robotic surgery. It's digital first GPs. It's really leveraging all this amazing tech we have to drive more productivity. It's a reduction in civil service headcount. We could reduce that by 25%. That's not something I'm making up. That would just take us back to 2016 levels. And there's so many things we could do to implement technology and drive efficiency. So if we can do the bold reforms and if we can drive the efficiency we need, I think everything's to play for. It's not that it's kind of inevitable that you'll have this managed decline. It's just that if you don't have the political will, it's not going to happen.
Lomax, what would you add? Anything that you think could be done differently, or how do you see the world?
I fully agree with Mads. We need to reduce that, but it's very, very hard to do it. Thank God I'm not in politics.
Well, let's see how this unfolds, and I know that this is going to be a topic for future pods. Thank you, gentlemen. We need to talk now about the EU AI Act. There's been some pressure for the EU AI Act to not come into force, and it's supposed to be coming into force in August. 44 major European firms have called on the European Commission President to introduce a 2-year pause. However, let's start with what is the EU AI Act. It's a first-of-its-kind comprehensive AI regulation aiming to ensure AI in the EU is safe, trustworthy, and human-centric. There are fines, there are things that happen to you if you get it wrong. There are fines of up to 35 million euros or 7% of global turnover for violations. And why are they calling for a pause? One critical issue is that the AI Code of Practice missed its May the 2nd deadline, so companies have no idea what to do. Other issues include restricting European competitiveness, there's an innovation risk, how these regulations will overlap with other laws, there's no agreed standards or rules of implementation. So I think it's totally fair that these 44 companies are asking for a pause. Do we think the request will be listened to? Mads, if it does get delayed, how will this affect startups? Would they be affected? How is this going to affect the real world?
Yeah, I'll touch on first and whether it'd be listened to. I'd say absolutely. The mood music we've had coming out of Brussels this year is that there's really a newfound understanding of just how precarious our economic position is here in Europe. And I think that's coupled with the newfound dynamism we're seeing in Germany and sort of this desire to invest. we're similarly seeing, I think, in Brussels, an understanding that maybe we went a bit too far on some of these regulatory pushes. So I think you'll get at least a partial win here. Could there be a 2-year pause? I don't know. I think maybe it's a shorter implementation period, quote unquote. But I think what will happen during some of that implementation period is I think some of the requirements will be watered down. And if not, the startup impact could be brutal. Now, the European Commission, they assessed that only 5 to 15% of startups would be touched by the regs. But when surveying startups, they're saying that up to a third are saying they think it would be directly impacted. And that uncertainty in itself is a massive, massively driving outcomes negatively, because uncertainty impacts behavior. And so, one might ask, what's driving costs? Well, the AI Act is asking for a risk management system, a quality management system, more technical documentation requirements, some data government requirements. And all of this sounds sensible on the surface, but if it adds hundreds of thousands of euros of cost to startups early on, before they've had any customers, that just slows down innovation, and it gives Europe a real disadvantage compared to US and Chinese competitors. We can talk more about the sectors where we see this unfolding, but I'd love to hear Lomax's take on the same.
I don't think they're gonna stop the clock on this. I think they're gonna keep going.
Really?
I think it's a bit. I think it's a bit shocking. What I find shocking is the act has already been passed, right? It's coming in phases over the next 2-3 years. Big deadline is August. What was shocking was on the 2nd of May, they were supposed to deliver this code of conduct, right? The code of practice. The code of practice is if you're sitting there as a chief information officer, trying to work out, or compliance officer trying to work out how to actually implement these laws, you need this code of practice. And the EU is now delayed it till the end of the year. So how the hell can you put in place new legislation and then say you're going to put out a code of practice to help companies actually comply with it, and then you're 7-8 months late, and then you still crack on with implementing the legislation? I think it's actually fucking mad. I don't know where these people get off. And this kind of is like GDPR on steroids. This thing, you look at GDPR, it's cost I think it's overkill. And it costs startups thousands, it costs medium enterprises tens of thousands, hundreds of thousands, and it costs big companies tens of millions. There's a whole industry of regulatory consultants who have made a fortune off GDPR. They're now just going to switch their hat, and they're going to make a fortune out of this AI Act. I think it's just crazy. And then you look at the fines on it, a bit, they're up to 7% of global turnover. I mean, GDPR was 4%, so this is nearly double what GDPR was. Amazon was fined up to $1 billion 3 years ago. It's like these US people, it's just going to not give us the products we want. From the users are going to suffer. So I think I think the whole thing, and Mads is right. There is a bit more of a push now in Brussels because they've realized that we need to actually, not implement so much red tape. But there's a whole industry of people who are just incentivized to push out red tape, and I'm sorry, it's an absolute disgrace.
So great for red tape
I agree
startups.
with most of what you've said. I would say we actually have form for some of this watering down. I mentioned, I don't know if you recall, earlier in the year we were talking about the Corporate Sustainability Due Diligence Directive, which was this flagship new Green Deal measure. And that's been watered down massively this year, where you increased the threshold for what size of companies need to report. You changed the threshold for when reporting needs to be made and how much needs to be made to make it less onerous for smaller companies. And I must say, I could see something similar happening here. I hope it will be, because if not, it's really not great.
Yeah, it's a bit harder technically. Don't forget, this act has already been passed into law. This is not some consultation in the run-up to a law. It's actually already in law. I mean, so you know what I mean? So it's for the people who would die in the ditch. I want this to be enshrined as it was intended. It's harder. The bar is harder to fight those people. But yes, you're right. There is a growing cohort of people within the EU who are trying to cut down on these things, but I think they've got their work cut out.
Well, let's assume, gents, that it happens. Let's assume this is all going ahead. Who's going to be affected? How is it going to affect us? What sectors? What do we need to look out for, Mads?
So there's 3 specific places to look. I would say is healthcare AI is a place that will be massively impacted, because they'll have the double compliance of existing regulation, but also the AI Act, which is because, a lot of the tech would be dealing with sensitive data, and dealing with sensitive data in sensitive ways around people's health would face a lot of scrutiny. So that will really add to costs and slow down innovation for healthcare AI. The other one to focus on is financial AI, where you're already dealing with a lot of MiFID and GDPR rules, and you're going to have the AI rules, AI Act rules on top. And then the third one is around B2B SaaS. And we'll often say, look, we are maybe less impacted in a lot of B2B areas and a lot of verticals from some of the regulation you see in healthcare, for example, but many enterprise customers won't touch tools unless you can prove that you are compliant with the legislation. And so again, here it will lead to slowdown. So as I said, I do hope that we can find a way to address this. It's not great.
Doesn't this also stifle innovation in open source as well? Like, aren't you just less incentivized to build open source?
Yeah.
I mean, I guess
I think they're extra screwed, I think. I want to talk about Cloudflare. I don't know if you caught Matthew Prince at Cannes last week. I was quite emotionally touched by he was on stage talking about the internet and how creativity is going to be crushed by AI, and what he at Cloudflare and what they were going to do, the product they were going to release. You could argue in one hand it was quite a self-serving, we've got this problem, I've got this product to serve it and solve it. But I think the intent is absolutely brilliant, clean and pure. But let me just break it down a little bit. So Matthew's insight was that the business model of the web is search, but AI is now eating that lunch, and it's problematic. SEO is dead. Content creators are being absorbed, dissolved, and dispersed by AI. You can't have a market without scarcity, and you can't have the internet as we know it without content creators. So we've got these two opposing forces, and we're in a bit of a death spiral. He also gave some numbers which I thought were quite telling. So 10 years ago, when Google crawled one of your pages or one of your websites, you get 2 page crawls per visitor. 6 months ago, Google was 6-1, OpenAI was 250-1, Anthropic was 6,000-1. Now Google, 18 pages per visitor, OpenAI 1,500-1, and Anthropic 60,000-1. So creators and publishers are getting a lot less bang for buck. His answer, he wants Cloudflare to enable content creators to gatekeep and charge AI bots before they're allowed to scrape, which I think is just eminently sensible. Now, when you look behind the business, Cloudflare only own about 20% of traffic, but they are the biggest player in the space. And it was an incredible watch. If you want to search it, Matthew Prince, Cloudflare, Cannes Lion 2025. And if you just search that, you can watch him on stage, and he talks for about 20 minutes. So I guess the question for you, and maybe Lomax, you can kick this one off, is this the beginning of a new gatekeeping revolution? Are we going to start see how AI manages the web and how content creators can work on the web in a new way and monetize, do you think?
I think, yeah, I think it could absolutely be the start of a gatekeeping revolution, but only if infra players like Cloudflare are joined by publishers, content delivery networks, and regulators. What Cloudflare is doing is
I think weirdly, some of the AI companies are also signing up. I think they get it, is my sense. I think they get it.
Yeah, and actually, just having talked about regulation, like I don't think fixing things through regulation, sometimes it works, but in this case, I don't think it works. So you look for market-based solutions, and I think maybe this is actually could be the solution if you're an optimist about it, right? And what they're doing is clearly, flipping the web's default from free to crawl to ask and pay first. So it's not too late. The window is closing, I think. If we don't act now, the open web risks becoming a free training set for AI with no incentive to create anything. And it kind of reminds me a little bit of the Napster Spotify situation. And maybe we're in the messy kind of middle phase before the new rules and the models settle in. So yeah, it's not too late for sure. I think it's interesting. And good on this dude.
Yeah, I think so too. Mads, horse bolted or not?
The horse is definitely bolted for foundation models. OpenAI, Anthropic, Google, they've already trained on the open web. The future models, they need fresh data. That's really where the choke point is. But I think, paradoxically enough, I think the irony is that these types of rules will accelerate AI dominance. They don't slow it, because a paywall like this will help incumbents. They've already data mined the full internet. All they need is agreements with a few of the top publishers to get news. That's the only thing they don't have. And it's much easier for an OpenAI or an Anthropic to afford to buy that than it is for a smaller developer. So I think what you're going to do is you're going to cement the dominance of the big players. You're going to have a 2-tier system where you have the premium tier, which are these amazing US foundation models that we all use and think are incredible. And then you can have an underground tier of open source models that are trained on pirated data. We can all guess where they're going to come from, and they're also going to be very, very good. But I think the risk for Europe is we're going to be stuck between wanting to follow the rules, as we always do. We're going to pay for premium. China's going to train on everything. And I think this would pretty much be the nail in the coffin for any hope Europe has of developing a frontier AI model.
You've just nailed European foundationals. Not that there was much happening anyway, but you've just absolutely shut the gate. But there will be some new business models, right? So Lomax, it feels like, let's say this is going to be the new paradigm. What new business models will come out?
Yeah, I think that therein lies an opportunity. API first monetization, licensing layers for AI training, infra level monetization, platform native monetization. So platforms like Substack will keep creators behind paywalls where AI can't easily scrape. So I think all of this enables those kind of things, but they're all going to have to be tested in the usual way that new business models are, right, in the market. So I like open season, like long may that continue, and we will enter into a sort of new with the whole of AI stepping back. We are in this big experimentation phase, generally. So this is just part of that.
I think it's super exciting, and I think he's going to make inroads. Is my personal take, and I think this is going to be a new swathe of opportunity for startups to build in this space around control and measurement and gatekeeping and all of these very niche vertical AI applications. I think it's going to be super interesting to see. One thing also I want to talk about this week about AI was I don't know if you saw the Microsoft research study that pitted real world doctors against AI to see who performed best. They built a tool called the SD Bench, which was real world medical mystery cases from the New England Journal of Medicine. And then they put human doctors and AI together and see how they perform. Now, the results are not, I thought the space between was quite vast, but obviously everyone would expect AI to win, but it was quite a difference. So human doctors got the right diagnosis in 20% of cases, and AI got it right in over 80% of cases and solved those cases with fewer resources and less money. So Lomax, the end of doctors is my big, bold statement for you.
Yeah, I know it's a bit too optimistic. I think it's the start. We've already seen this. It's not new, by the way. I mean, implementing software and or AI into the medical field, into doctoring is not. I mean, remember IBM Watson, right? IBM put $5 billion into that project over the last 10 years and eventually shut it down. So, yeah, exactly. So I think what it probably heralds is a continuation and a massive step change in the sort of doctor plus technology, doctor plus software, right? So the sort of tech-enabled doctor. I mean, this is interesting. It's good. The results are impressive. But don't forget, this is a retrospective trial, right? The gold standard for any kind of clinical trials is prospective. Yeah, they actually take place in the real world environment over patients as they come in on a forward-looking basis, rather than taking a data set and looking backwards. You go forward. So, if you want to get any of this implemented into your healthcare systems, it's regulated, right? Highly regulated. You need to run prospective trials. Those things cost tens of millions of dollars, right? Especially at this scale. Clearly, auditing of decision making, right? You need the ability to look through and the explainability, why decisions were made. You haven't got that yet with the models, so I think that's going to be another thing to work on. In theory, there are also these cost claims where they're basically saying not only are we making better decisions, we're also saving money by sending people to cheaper diagnostics, etc. I think in the real world, that's got more to be done. But I think it's part of a trend that we're seeing, which is that doctors, a bit like we use ChatGPT in our day jobs, it will be and lawyers are using the same. Doctors will use more and more, and that will continue. And there is an analogy here, right? If you look at what's happened in the medical field, it's imaging. So computer vision was used to look at images, so CT scans, PET scans, MRI scans, ultrasounds, to actually, because of the AI, computer vision is very good at looking at patterns and recognizing patterns. There are 1,000 FDA-approved algorithms, AI algorithms, right, for imaging, right? We've gone through that in the last 6 years. Do you know how many of those 1,000 are AI only? One.
No clue.
One. All of one. So 900. The remaining $999 is doctor plus AI. They make the decision together. You're the radiologist, you use the software. It's clinical decision support services. It's a huge industry. CDS, clinical decision support. That is what's happening here. Doctors are going to be using AI to support their decisions, and it will no doubt be a great thing. It will reduce costs. It will hopefully improve outcomes. But it's not. You're not going to be walking into a robot at some point. Maybe in 100 years' time, this will happen, and a robot will be doing everything for you. But certainly in the sort of near to midterm future, it's doctors plus technology. So I think it's great to have seen this, but we've still got a way to go.
Mads, will it save the NHS?
I think the NHS, as we've talked about, is facing a perfect storm. You've got a wait list of 7 million people needing, attention, and so we need a productivity breakthrough to drive that. We have had an announcement of £2 billion, kind of an AI fund to help drive some innovation, but we also know that the NHS is still suffering with IT infrastructure from the 1990s. We know that procurement timescales are quite long. And so this is not going to be an overnight thing. But I'd say from a startup perspective, where are the opportunities? There will be pick and shovel plays around infrastructure, specifically for the NHS. There'll be lots of vertical opportunities for specific diseases and specific conditions. And then I think it's worth remembering that in Europe, we have a unique advantage in our healthcare systems, which is we have all these single payer data set, all these government-owned data sets. That could be massively transformative in terms of developing next generation technology. So again, if we do it right, I think there's a lot of upside here.
Wonderful.
Yeah. Don't forget, who are the gatekeepers here, right? If you want to bring these new technologies to market, you have to go through the regulator, get it done. You then have to go through and integrate with all the existing software. So the existing software systems, the EHRs, the medical record systems, you have to go through basically the chief information officers of the hospitals. And who's the gatekeeper at the end? The doctor. You need the doctors to sign off on all of this stuff. So, all this new medical software, I don't think they're going to be voting as turkeys for Christmas quite yet.
Left field thought for you. Gen Z doctors coming in are going to be much more AI friendly, technology friendly. So is there going to be
I agree.
a kind of a generational awareness and push for tech? It feels like that might be a factor.
Same with lawyers, other knowledge workers. Yeah, for sure. 100%.
Right, let's move on to Deal of the Week. Now, I just saw, this isn't Deal of the Week, but I just saw Clio acquired VLEX for $1 billion, which I thought was bloody brilliant. But your Deal of the Week, Lomax, what's happening?
Deal of the Week is my deal. So, I'm talking my own book here, but this is a Portal Biotech has just raised a $35 million Series A led by Early Bird and the NATO Innovation Fund, the $1 billion fund backed by the NATO member countries. We did the seed round 3 years ago. This is a protein sequencing company. So they are working on developing new technology using nanopore-based technology to sequence proteins, which will unlock further advances in diagnostics and therapies, and also outside of healthcare in food and also in biosecurity, which is why the NATO Innovation Fund are interested in this. It's a good example of great technology or great research that came out of the University of Groningen in the Netherlands, married with great operators who actually came out of Oxford Nanopore. So Oxford Nanopore is a nanopore-based gene sequencing company in Oxford. So this is now operators spinning out from that's a $2 billion, I think, market cap company. It's a good example of operators spinning out of a success story, marrying it with good research and building what hopefully will be the next Illumina. In the last 20 years, we've seen huge growth in the human genome sequencing, right? And costs have come down from millions down to $100. Hopefully, proteins is a much bigger space. There are 20,000 genes in the body. There's well over, a million proteins that need to be discovered, analyzed, etc. So this is great. And do we create another Illumina, which peaked at an 80 billion market cap in Europe? It's now down, but it was up. I'm very bullish on it. So well done to the team there, to Andy, and congrats to Harry at Science Creates, who did pre-seed, seed, and Series A on that. He effectively created the company with Andy as an investor. So that's an amazing result for them.
It's always nice to Deal of the Week. This one of ours. Pretty selfish, but I'm loving it. Loving your work. Loving it.
It's a great company.
Well, thank you very much, gentlemen. We will catch you all next week.
Bye-bye.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.